So the market reacted negatively after the Federal Reserve Economic Outlook meeting that happened in September 23rd. Here is the summary of the meeting. The US economy has moderated. Growth in the first half of 2025 is slower than in 2024, largely because consumer spending cooled down and housing remained weak. Take a look at what Jerome Powell said.
Recent data show that the pace of economic growth has moderated. The unemployment rate is low but has edged up. Job gains have slowed, and the downside risks to employment have risen. At the same time, inflation has risen recently and remains somewhat elevated. In recent months, it has become clear that the balance of risks has shifted, prompting us to move our policy stance closer to neutral at our FOMC meeting last week. GDP rose at a pace of about 1.5% in the first half of this year, down from 2.5% last year. The moderation in growth largely reflects a slowdown in consumer spending. Activity in the housing sector remains weak.
Jerome Powell also said that the labor market is showing signs of softness. The unemployment rate is low but rising slightly above 4.3% in August. Job gains have slowed sharply. Recent monthly numbers are below what's needed just to maintain employment levels. Both supply and demand for workers have weakened. Less hiring, fewer people actively seeking for jobs. Take a look at what Jerome Powell said.
In the labor market, there has been a marked slowdown in both the supply of and the demand for workers, an unusual and challenging development. In this less dynamic and somewhat softer labor market, the downside risks to employment have risen. The unemployment rate edged up to 4.3% in August, but has remained relatively stable at a low level over the past year.
And then Powell talked about inflation, and he said inflation remains above comfort zone. The core PCE, personal consumption expenditure index, is running around 2.9% year over year. And part of the recent price increases, especially on goods, is because of tariffs, which Powell called it a one-time upward shift rather than a persistent inflation driver. Take a look at what Jerome Powell said.
Core PCE prices rose 2.9% last month, also higher than a year ago. Goods prices, after falling last year, are driving the pickup inflation. Incoming data and surveys suggest that those price increases largely reflect higher tariffs rather than broader price pressures. A reasonable base case is that the tariff-related effects on inflation will be relatively short-lived, a one-time shift in the price level. Now, a one-time increase does not mean all at once. Tariff increases will likely take some time to work their way through supply chains. As a result, this one-time increase in the price level will likely be spread over several quarters and show up as somewhat higher inflation during that period.
And then Jerome Powell talked about rate cuts. Jerome Powell said that rate cuts are not an autopilot. They will consider incoming data and risks before deciding further actions. He described the current situation as modestly restrictive, meaning that while rates have been eased, they are still tight, relative to neutral. He emphasized that there are two types of risks. If Fed cuts too aggressively, this cutting could reignite inflation. For example, the 2% returning to 2% inflation could remain unfinished job. If the Fed holds off too long, the labor market could suffer unnecessarily. Powell also made it clear that the recent rate cuts that happened in September 17 was intended to shift the stance toward more neutral, not to start an aggressive easing cycle. Take a look at what he said.
Two-sided risks mean that there is no risk-free path. If we ease too aggressively, we could leave the inflation job unfinished and need to reverse course later to fully restore 2% inflation. If we maintain restrictive policy too long, the labor market could soften unnecessarily. When our goals are in tension like this, our framework has long called for us to balance both sides of our dual mandate. The increased downside risks to employment have shifted the balance of risks to achieving our goals. We therefore judged it appropriate at our last meeting to take another step toward a more neutral policy stance, lowering the target range for the federal funds rate by 25 basis points to 4 to 4.25%. This policy stance, which I personally see as still modestly restrictive, leaves us well positioned to respond to potential economic developments. Our policy is not on a preset course. We will continue to determine the appropriate stance based on the incoming data, the evolving outlook, and the balance of risks.
Powell suggested that much of the tariff inflation is just a temporary shift in price levels rather than a long-term inflation trend. Powell also said that policies on trade, immigration, regulation, and geopolitics are in flux, and their long-term impacts are unclear. Powell also rejected the claims that said Fed actions are politically motivated, calling such accusations cheap shots. Powell also said that equity prices appear fairly high, but he did not signal major financial stability risks at the moment. Take a look at what he said.
That you should, I just have to say this, whenever we make decisions, we're never, ever thinking about political things. And so we're based in Washington, D.C., and many people, in Congress, and they're often things are seen through a lens of, is it good for this party or bad for this party or this politician? We're just not looking at things that way. We're looking at what's the best thing for the people that we serve in the medium term. What's the best policy? And many people don't believe us because they think, come on, you're really political. But the truth is, most of the people who are calling us political, it's just a cheap shot. And also, we don't engage. We don't, our argument is doing our jobs. We don't get into back and forth with external people. We just do our jobs. We keep our head down and do our jobs. That's what we do.
So after this meeting, the market reacted somewhat negatively. Stocks declined on Powell's cautious tone, especially since he did not commit to the promised future rate cuts. The speech reinforced that the future rate cuts are conditional, not guaranteed. The Fed is walking in a tightrope between inflation and the labor market, and markets will be watching every incoming data point closely. But the question is, what will happen to the stock market in the upcoming 12 months? I made a video where I shared the opinion of the 4 top Wall Street experts predicting what will happen to the market in the upcoming 12 months. So watch this video.